thing is everybody wants to learn or know about how to do a lease, right? What's the differences between doing a lease and financing a vehicle? Basically, it's a different way of paying for it. That's all it is. It's just a different format and a different way of paying for a car. So I'm going to break it down for you. Now, I'm not going to use a whole bunch of exact facts and figures. We're just going to use a generalization, and you guys are going to participate in it, okay? So now, first of all, let's look at a car. We got one that's we're financing here and one we're leasing here, right? So this car costs $20,000, and this car costs $20,000, right? We're going to call this the MSRP on this side and the MSRP on that side, right? So now what happens is you buy a car, right, and you have depreciation on the finance part. Do we say, let's just pretend for this example, the first year we depreciate 10%, which we all know ain't happening. It's going to be a lot higher than that. But for this example, we take 10% depreciation the first year. So now we got a car worth $18,000 as soon as we drive off the lot. And then plus we got tax, tag, license, everything in there. We got plus your interest rate in there, right? Your interest rate that you got on top of that, plus depreciation. And you're going to times this on the average loan now is 72 months in 2019 is pretty much the average everybody's going. Instead of 5 years, they're going 6 years. So you're kind of looking at that. Now, pretty much what we said is 87% of everybody goes through that buying cycle and finances a car, but the trade-in cycle is always between 30 to 36 months is the normal trade cycle between somebody. So if every 3 years that you're trading in a car, why would you want to be upside down? Because I don't care. The average down payment that you're putting down, let's just say, is $2,000, right? And that's covering part of your tax and tag at 6.25% plus your tag fees. Excuse me. Then what do you're got a whole finance package. You got your warranty in there, your gap insurance, all your stuff that you do. You have a fully insured loan, right? So you're going to go through that, and you're going to finance the car for 5 or 6 years, or this example, 6 years. What do you end up with at the end? You end up with a car that's realistically over 100,000 miles. It's really not worth as much as you think it is, or that much at the end of the day, unless you're passing the car off to a child or to a relative and you're giving it away, you're doing something with it. But what happened is, this original $20,000 investment that you made is gone. Poof. No longer exists, right? That $20,000 is gone 100%. You're not getting it back. So there's a lot of things you could do with 20 grand. Besides, do this and have it depreciate. Instead, on the other side, and let's just take, for example, you're paying $400 a month on this car, right? So now you look at the lease side of this, which the average term is 36 months, right? And 15,000 miles a year. That's the most common number. Now, included in that 36 months is the warranty, right? Because what's the new car warranty? Pretty much universally out of any brand is 3 years, 36,000 miles, bumper to bumper, correct? So you're already covered there. Now, if you were in a 10,000 a year mile lease, yeah, you'd go right to the 36, but you're in a 15, you're going to be over it a little bit, but you still got the powertrain to cover, right, the motor and transmission for that 15,000 miles. So you're really not embarking on it. The other thing is, most of these leases, and almost all of them that I know of, and there may be a few out there that don't, the gap insurance is already included in the lease. So, just to explain the gap part of it, gap insurance is going to cover the difference. Let's just say you lease this $20,000 car, and your insurance company, your car gets totaled, you're okay, nothing happened to you, you're fine, the car gets totaled, and the insurance company says, well, your car is only worth about $15,000, and because what you owe on it has nothing to do with what it's worth. So The insurance company is going to pay for what the vehicle's worth. So they're going to give you a check for 15 grand and tell you you owe the other $5,000. Well, instead, that's where the gap insurance comes in, because that kicks in and that covers up your negative difference between the two numbers, so you owe zero, right? Now you owe nothing. So that loan is fully insured that you don't have to worry about. And a lot of times, what most people do is they include the maintenance and all the oil changes. Usually adds up another $5 or $7 a month, and you got all your oil changes and your maintenance for that entire time covered in the lease. So now you're making that one $400 a month payment, right? Which includes all of this. Includes your oil, your maintenance agreement, everything's in there. But we have one other positive that we're forgetting about. Number one, we have a thing called a residual value. Now this is where it gets a little complicated, and not that complicated. So what we're doing is, in this manufacturer, let's say we're talking about Toyota, we're going 3 years ahead. And we're going to tell you, hey, this Toyota Corolla, we're guaranteeing in 3 years right now is going to be worth $10,000. Whether the market's good or bad, it doesn't matter. Based upon the history, the residual value is a percentage. So you'll see a residual value, which is another word for book value, says that it's worth, 56%. So they're telling you, in this example, we're going to say 50%. Car's worth 50%, right? So we're guaranteeing you 50%, so that car's going to be worth $10,000 no matter what at the end of 36 months. No matter what. Let's just say at the end of 36 months it becomes a big recall, and the value of this car is now worth only $5,000 because everybody's scared of the Corolla. Well, it doesn't matter. We guaranteed you it's worth 10, you're getting 10. What if it went the other way? All of a sudden now there's a shortage of Corollas. Now the car's worth 12 grand. We guaranteed you 10. That other $2,000 belongs to you. The good thing is you get no part of the negative and all part of the positive. So let's just say it's worth $12,000. At the end of this lease, you have 3 options. And I haven't got to the good point yet. You have 3 options. The first option is you get, at the end of 36 months, you give me the keys and we're done. You own nothing, not 1 penny. The second option is, let's just say the car's worth $12,000 or $13,000 and you want to sell it to somebody, right? So now you could sell the car for the $12,000 or $13,000, and then you cut Toyota a check for 10 grand. You keep the 3 grand. It's your money. Or you take that number, it's worth 13,000 or 12,000, and you could trade the car in because you owe nothing, and then that $3,000 goes towards your next deal, and the payoff is still 10. So now you got $3,000 worth of equity that's moving forward. Now you're no longer in this scenario where you're in the negative, but here you're only in the positive, right? So now now here's the beautiful part of it. Any questions on that part? So the residual value is just another name for a book value, and when they give you that percentage, which you can fluctuate that by 1 or 2%, because that 36 months, you have that guarantee, right? You have a guarantee of $10,000. But you could get a 10, 12, 15,000, 18,000, 20, 25,000 mile lease per year, whatever you decide your driving habit is. So when you look at your customer's car as a trade-in, and you look at the miles, take the year, and let's say it's a 2015, and they got 40,000 miles, divided by those 4 years the car's been on the street, the guy's driving 10,000 miles a year, right? He's perfect. So you work him up a 10,000 mile a year lease, and this is going to make his residual value even higher. Instead of it being 50%, it may be 51, 52, or 53%, because he's going to drive less miles. Or it could go the other way around, where maybe the guy drives 20,000 miles a year, so now you give him a 60,000 mile 3-year lease. Either way, what happens is the guy's back in the market, coming back to you in 36 months. And a lot of times we have things called a pull-ahead program, and that pull-ahead program means anytime within the last 6 months, or sometimes in some manufacturers a year, that you have left on the lease, they'll give you an incentive or a special rebate in order to make you trade in the car now and not wait the last 6 months. But guess what they're sending the customer? Right back to you. So just imagine if you're selling 20 cars a month and you're leasing most of your customers, what's going to happen on your third year of business? You got not only the 20 you're selling, plus all these other repeat customers start coming in because their leases are up. Because the reality is, we said 87% of America finances a vehicle, right? So if they're doing that, and they're all in this cycle of financing, if you convert them to this cycle, you're going to get all those customers back every 36 months. Well, when you get to your third year, you're going to be busy, right? Every month it just gets better and better and better as you keep going on, because you're recycling these customers. Because what's the difference? They're financing this car for 72 months now, and they're trading it in 36 or 30 months, right? So what's the difference? Instead, cut their financial obligation shorter, so they ended up with this. Now the beauty of the money that comes into this that you could do as a person only is going to exacerbate the situation. Number one, let's break out your calculators, take 400 a month times 12 equals what? 4,800, right? I love this part. Now, the IRS, and I am not a tax expert. I know what I do and a lot of other people do. So I'm going to throw that disclaimer. I'm not a tax expert. I'm not going to tell you how to do your taxes or anything else. A lot of accountants don't even know this, but I do my thing simply. The IRS on a personal lease will give you 80%. So you times this by 80%. What's 80% of 4,800? What is it? $3,840. So automatically you get to write off your taxes, $3,840. Comes off of your tax line obligation. Plus you get $600 a year minimum for gas. Plus you get plus you get $1,000 for maintenance. So that's $1,600 plus $3,840, right? That's 6 is, what is it? So you get $5,440. Now you get, if you don't abuse the system, they'll give you anywhere from 18 cents to upwards of 32 cents per mile, depending on your driving. If you take the minimum and you take 18 cents times 15,000 is what? At 15,000 miles a year is what? 0.15 times 15,000 is what? $940? No, it should be 2,700. I don't have my calculator with me. 2,700? So it should be 2,700. So now you got 0, 4, you got 11. So you got $8,140 minus 4,800 is what? 8,140 minus 4,800 is what? Somebody do the math real quick. So now you're at a positive of $3,340. So not only did your car not cost you any money, you made at the end of the year $3,340 times 3. So you made almost $10,000 over a 3-year period to drive and drive for free and spend nothing on this side. Yes. That's why you see a lot of people and a lot of professionals, like lawyers, doctors, accountants, that kind of thing. They drive these heavy cars, Mercedes, BMWs, big money, spending $1,500, $2,000 a month. Well, you times that by 12, and they're doing their personal lease, they're taking a huge chunk off of their income tax that they're getting back. So that car didn't cost them a penny. They made money on it. Understand? Yes, sir.
You get, in this case, 15,000 miles per year. What happens if for A or B you drove more than that in a year?
Perfect example. Yes. Okay, so let's just say you sign up for a 10,000 mile a year lease, right? My son is a perfect example. I leased my son a brand new Ford Fusion in 2016 as a gift, right? So I forgot to tell him be careful on the miles, try not to go over. So he tells to me, he says, hey, Dad, I think my lease is going to be up. I got to do it. He's supposed to have 30,000 miles on it, and he's got 45,000. So he went 15,000 miles over the lease. You know what we did? We traded it in for another lease, and the miles meant 0. Or you could pay for the mileage, because they're going to, at the end, if you don't want to trade in the car or do nothing, and you just want to walk away, yeah, you're going to, there's a charge for the mileage anywhere from 8 to 15 cents per mile, depending on the manufacturer, and in whatever it is at the end, you're going to cut them a check for the miles. Yes?
You can also buy the car after the lease, right?
Yes, that's a bad idea, but because you got to look at the value of the car. So let's just say the car's worth $9,000 and your buyout clause is $13,000. Why would you want to pay $4,000 more for the car than you need to? What you can do is if you do it right and look at your mileage history of your personal vehicle and figure out how many miles you really do drive a year, you may drive 8, 15, or 18,000. Set your lease up for that starting out. Say, hey, I drive about 15,000 miles a year, on average, so you buy yourself a 15,000 mile lease. And understand, if you go over or under, it's not the end of the world. It's not a big deal, because at the worst case scenario, you're going to trade it in for another lease anyway, and the reality is if the dealership keeps the car, there is no penalty or nothing else. You're just trading it in. But it's going to cut your, if you are upside down at all, it's going to make it very minimal. Yes?
What about the opposite side of that? Somebody that doesn't drive the lease very much.
They're the best candidate. Well, because now if you get a 10,000 mile lease, your payment's going to be super cheap, and you're going to have equity at the end of the day.
Say they had a lease for whatever miles it was. For that, that's what I'm trying to figure out.
Right.
So say she had a 10,000 a year lease, but she's had it 3 years, she's only put 10,000 miles on it.
The car's value is going to be sky high.
She may be upside that will help get her out of the deal.
It depends, okay? If you're in the very beginning of the lease in the first year, you're not going to have nothing. But once you get more than 50% through a 36-month lease and you're way behind on the miles, you should have, you bought a 15,000 mile lease and you should have somewhere around 25,000 miles on the lease, and you only have 6 or 8. Well, the value of the vehicle is only going to be that much higher, especially depending on the vehicle. If you got a sub-brand that's not worth a lot to start with, it is going to make a difference, but not that much. You got a nice car, a Camry, Corolla, Lexus, that kind of thing, a nice Chevy, a nice Ford, a nice Dodge, or whatever it is, and you're way behind, at the end of 36 months or end of 30 months, you should, let's say, have 45,000 and you only have 20. Well, that money doesn't disappear. It goes to the value of the vehicle. So the vehicle is going to be worth a lot more than you thought it was, and there's a good chance you may have a solid piece of equity at the end of the day. But the beautiful thing is, a lot of these leases, a lot of people, they require, any lease that you have, your first car payment is due today, right now. You sign a lease today, your car payment's due today, and a lot of dealers, that is an incentive, what we do is we add in that first payment. Now what you could do is put that down. A lot of leases will have a security deposit, and maybe you're paying your tax and tag. So if you end up putting $1,500 down, it just makes the payment cheaper, makes your residual better, your whole lease is in a better thing. So now once you do your first one, a lot of things that happen afterwards is what we call a sign and drive. You come in to get your new car, you call up the phone, say, hey Andre, my lease is almost up on my Camry. I want to come down and get a new one. I'd like to get kind of the same thing, and but a different color. Andre's going to look it up, see what you're in. He's going to say, yeah, no problem, Bronson. I got one. He's going to come in, look at everything. You're going to do your same deal, your whole road to the sale, the steps. Now he's going to get another one, but maybe he has a little bit of equity. Maybe he's even, whatever. Second time around, just sign for it and go. And a lot of times, more than not, your leases are all sign and drives where people don't even have to put any money down whatsoever, and they end up with a cheaper payment than they are financing. Yes?
So you could just go up to the dealer with, let's say you had a lease of 15,000 miles, you arrive at the dealer with 20, and you can just trade it in for the same model and renew the lease and go, and you're good. You don't have to pay anything extra.
Usually not, no. If you're a little bit over on the miles, it's gonna make a difference if you're, let's just say you're 5,000 miles over, right? So what's 15 cents a mile times 5,000? What is that?
0.15 times what?
Yeah, times 5,000. 750 bucks? Okay, so that's your penalty basically. $750, which easily could get swallowed up in a new lease. Not the end of the world. So they know that. Everybody will. And the other thing though is you got to have good credit. You can't have shitty credit and do this. You got to have good credit. So, you know, as far as the beacon requirements and all that stuff, it's different at every manufacturer and every car line. But basically, you got to have good credit. Now, my son, you know, his credit is perfect, and he had I think a 620 and a 640 and a 640 something on his beacon score because he's a young guy, and you know he's got a lot of stuff out there already, so his score's a little lower. But he got picked up, boom, 2 seconds on the new lease on his new car. So, and everything got rolled over and got no issues. Driving a brand new vehicle. And the best thing to do is a lot of people do is you stay in that car line. So if you bought a new Toyota Camry, now you want to go to a RAV4, next year you want to go to a Tundra, next year you want to go to a Tacoma, you can keep doing it and doing it and doing it and not paying for a vehicle and having your money free, because instead of here you're throwing away $20,000, here you're not throwing away anything. You're doing nothing but gaining, right? So when one day you decide to retire and you got all your cash in the bank, you want to write a check for a car, go ahead. It's your last one. Yes.
So basically, this is the way you rebut someone saying that if you're leasing, you're throwing away money. Because I hear that a lot. I hear a lot of people saying that when you lease, you throw away money.
Bro,
Yeah, because they don't know.
there's an argument that I always say, it's a lease, but I would never own it.
Yeah, you would never own it. You don't own this either. Go ahead and miss your first car payment or any car payment during that time, and you'll see how fast you own the car.
By the time you own it,
When you go to your driveway and there's nothing there, and you call them up and they say it's gone, you don't own it either. The only way you own the car in this world is if you have the title in your hand. You paid cash for it, you own it. Anything outside of you having the title in your hand, you don't own it. So why not make your financing the cheapest it could possibly be? And the great thing is, these deals on the leases, we do them all at full sticker. So not only do you make personally a lot more money per deal, but you have a guarantee of a returning customer base. And if they got the credit for it, why wouldn't you want your customer to be in the best financial position they could possibly be at? Now, this isn't going to work for the guy who drives 75 or 100,000 miles a year. No. Now, I got one of my vehicles as lease because my wife doesn't drive a lot. My truck is not, because I mean, my truck is a year and a half old, and I got 75,000 miles on it already. So, but one of my unlucky kids is going to get to have that.
So if there's a person, say, $7,300, owes 10 payments, 730,
Right.
to throw it in the lease. The wife says, oh, Toyota.
I know where you're going. Let me tell you how this works. So at the end, let's just say somebody's a year and a half or 2 years in. You have two different ways that the vehicle is going to be paid off. You have one, which we call the balance of lease payments, okay? So you times the payment by however many payments they have left. If they have a 36-month lease and they've already paid for 30 months and there's 6 months left, it's whatever that payment is times 6. That's how many lease payments. Then you have a second clause, which is the buyout, which you have to call and say, hey, I want to own this. I want the title. What is the buyout to this? They're going to give you a number. All those two numbers are also based upon how much is the car worth. We're going to do two things. We're going to look and see how much the car is worth versus how much the buyout is, what the car is worth versus how many lease payments are left. And we're going to decide which way to best structure the deal if we're going to be adding money to it. We don't know until we know the answers to those questions. So if, let's just say the buyout is $18,000 and the car's worth $10,000 and there's $8,000 floating difference there, that may not be a good deal. So maybe if they have 6 payments left for $3,500, I want to get them out. What I'm going to do is I'm going to cut a check for $3,500, and I'm going to send it to the bank and let them keep the vehicle, because we don't want that $8,000 worth of negative equity. What we're going to roll in is we're going to roll in those last 6 payments into their new lease. That's what we're going to do. We're going to take that $3,500 and we're going to add it into the new lease, and we're going to pay off the other one, because the other one, what the buyout is and what the value is, are too far stretched out from each other. They don't work. Or it could be, you know, hey, we got 7 payments left, or 12 payments, or 15 payments left. It comes out to X dollars, and then we look at right now. Okay, what's the buyout as of today? The buyout is 20 grand, and the car's worth 22. We're not going to worry about the payments. We know we're going to use it as a trade because we got some equity, or we're broke even, or we're not putting $3,500 worth of negative in. We're only putting 2 grand. The managers are going to structure that deal to figure out which is the best case scenario on somebody who's doing an early termination on a lease. Okay? If you're in the finance part of it and trying to do that, it would really be hard. Because you got somebody who's got a 5-year loan on a brand new vehicle, automatically they could be 10 grand upside down in a minute. So we know that's not going to work. Because I have seen people be $10, $12, $15,000 in the negative easily. But I've never seen anybody that heavy in a lease that was at the end of it. When they're at the end of that lease and they're on a 36 months and they've surpassed 2 years, we're starting to get relatively close to being to payday. So the closer to the end, the better. And trust me, everybody that you've leased in your scenario, in your arsenal of customers, okay, you're going to get notifications when those are coming due. So you could start calling them up and start marketing to them. Say, hey, I know you're 6 months out or 12 months out of your being done with your lease. I just want to let you know, I want to give you this option, that option of what's coming up. You're going to start marketing to those people. Any questions?
So if the value of the low mileage lease is more than buyout, and there's some room in there to go into the next deal, and the payments that are owed, kind of lost me when we got to that part.
So
Maybe I have.
there won't be any payments. So in other words, if you're dealing with a lease, right, and the guy is going to trade the vehicle in, and he is pretty much he's got a 36-month lease, and let's just say you got 3 payments left. He's at 33 months. So we're going to look at what the value of the car is today. We're going to appraise it like a normal trade. Say, okay, this car's worth 10 grand. We're going to call up and find out what the buyout is. If we think the car's worth 10 grand and the buyout's 14,000, we're not going to take it in on trade. We know we got 3 payments left. Maybe we got a $500 or $1,000 rebate. We're going to cover it, and we're done. That's it. Car's going to go back. We're going to pay the 3 payments. We're going to clean it up. They're going to pick it up, and they're going to take it, send it to the auction. We're done. On the other scenario is we look at it and we say, okay, the car's worth 10 grand, and the buyout's 5. We got $5,000 worth of equity. We want that money, so we're going to apply that to the new one and make their payment that much lower. Okay? Because their payoff's low. Yes. Go ahead.
So, about that money over there on the bottom, excuse me, those, exactly, you get those back by doing your taxes regularly like you always do?
Yeah. Like if I use TurboTax or one of those guys, and it says your vehicle leased or financed, and I click on lease, automatically it'll count me as a personal lease. It'll ask me, do you drive to work? I say, yep, I drive my car to work every day. How many miles do you put on it? How many this? How many that? What's your maintenance? And I'm just using the basic stuff so I don't get red flagged by the IRS or have somebody else saying audited me. There's plenty of apps out there which are mileage apps that'll keep track of the mileage on your vehicle while your phone's plugged into your car. And all you have to do is plug them in. You can keep a whole mileage log if you want to, and you can maximize out your mileage and even get more money back. But when you plug all this in and you do that, on this scenario is going to put you in the green and put you at 3,300 plus whatever other refunds you got. You're going to end up getting that money back. Could you end up with that in cash? Yes, you could, depending on what your refund is. Now, I haven't gotten a refund in my entire life, but yeah, I'm sure. Yes.
When you finance a car, is there an equivalent tax savings?
No.
Finance?
Zero.
Zero.
There's none.
something you mentioned
Right
there.
off the sales tax, still.
Yeah, but it's a couple $100.
So is it guaranteed when you put a personal, lease, you get the 80% back?
Yeah,
Is it guaranteed?
yeah. If you get a personal lease and you drive the vehicle to work, you can maximize out of it at 80%. They're not gonna allow you any more than 80%. But if you're using it for pleasure, you may lose that tax savings. So as long as you've got a personal lease and you're driving it to work and you're setting so many miles and you drive it to and from work every day, maybe even sometimes you use it for work on certain things, yes, that is a deductible thing. And then again, I'm not an accountant, I'm just telling you what I do and how I do it.
So is this a good pitch for someone to
100%.
switch to
Yeah,
lease?
absolutely. Because you can show them the financial dip. Even if you didn't tell them about this part of it, just this part of it alone is a good deal. Because they're never going to be upside down. Okay? Think about it. You could buy whatever brand new car you even think of, as long as you can afford the payment, and every 3 years you're going to get a brand new one. Every 3 years, and you have to pay for nothing. You make one payment.
And lease payments are usually lower, right?
Usually, yes, because you're only paying for 50% of the vehicle. So you think about it. Yeah, you're paying for half the amount of time. You're paying for half the amount of time, and you're paying for half the car. So the reality is you're going to average out, and it is normally typically between $80 to $120 less. Okay? We could stop.
Are we still gonna wait till 3 or?
We could do it right now, sweetheart. It's all you.
Okay, so.
Ever remember Mary Jarvis?